SOFI just posted a triple beat quarter, ripped about 7% pre-market, then face planted about 8% from the open. All in the same week, like the market was speed-running emotional damage. And before we begin, not financial advice. This is Fintech Spy, where we read charts like they owe us money and then we apologize to our brokerage app. Welcome back to Fintech Spy. Today we're covering SOFI, a ticker that somehow managed to deliver a respectable earnings report and still get treated like it showed up to the party wearing Crocs. Here's the vibe. Earnings looked strong on paper. Guidance got raised. Member growth hit records. And then the broader market came in like, that's cute. Anyway, have you tried panicking? So we're going to do what we always do. Zoom out, zoom in, and then zoom into the options chain like it's a crime scene. We'll hit analyst updates, earnings, and news nuggets. Then the weekly, daily, and 4-hour chart reads, and we'll finish with options oddities. Because nothing says healthy market structure like a pile of open interest sitting above price like a ceiling fan with anger issues. Not financial advice, entertainment only. If I say support, I mean a place where hope goes to get humbled. Analyst updates. Post-earnings, we didn't get the dramatic downgrade to the shadow realm headline. According to the sheet, no brand new ratings dropped right after earnings. Mostly reiterations with price target tweaks. Like analysts walked into the room, nodded solemnly, and said, I still feel the same, but louder. The average price target is still hanging around $27, which is hilarious, considering price is sitting down at $22.78, like it's waiting for the bus. That's a pretty chunky gap between what Wall Street says and what the market is currently willing to emotionally accept. The standout. Dan Dolev at Mizuho bumped the target up to 38, which is the kind of number you say when you want to be remembered at the reunion. Meanwhile, Bank of America lowered theirs from $20.50 to $20, which is the sort of analysis you publish when you have nothing to add but still want credit for being technically involved. Like, congratulations! Your spreadsheet can subtract 50 cents. So the analyst narrative is basically, we're still optimistic-ish, we're still watching, and we would like the market to stop being weird. Unfortunately for them, the market has declined to stop being weird. Earnings news nuggets. Earnings were objectively solid based on the facts you dropped. They beat earnings per share, printing 13 cents against a 12-cent estimate. That's not a moonshot surprise, but it's a clean win. Like showing up on time and remembering someone's name. They beat revenue too. $1.01 billion versus an estimate listed as $9.77 million on the sheet. Now, I'm going to say this carefully. That estimate figure looks aggressively small for the context. But I'm not here to invent numbers or fix the facts. The important part is, the sheet says it was a revenue beat, and the market did initially react like it was a revenue beat. Hence the pre-market pop. Guidance also got raised. 60 cents for full year 2026, and 12 cents for next quarter. That's the company basically telling the street, yes, we brought receipts, and yes, we think we can do it again. And the growth metrics were spicy. Record 1 million new members, and 1.6 million new products. New quarterly records across both. That's not a small flex. That's the corporate version of doing a backflip and landing it. Then immediately checking your phone to see if anyone liked it. So why did it still dump? The sheet calls it out. After running up pre-market, the stock pulled back about 8% from the open. And it pins the blame on macro issues. Translation. SOFI did the work, but the broader market atmosphere chose violence. Weekly chart facts. On the weekly, the phrase that matters is still stepping down. That's not free fall. But it is, the escalator is going the wrong direction and we're pretending it's fine. Volume jumped. Best weekly volume since last year. And the sheet says we've returned to the normal volume period. That's important because big volume after a move can be either capitulation or distribution. And the market loves to keep that mystery alive like a season finale cliffhanger. Momentum on the weekly continues to cool toward neutral, which matches the stepping down tone. Less panic, more slow bleed. The kind of action that makes traders start negotiating with the universe. Oscillators are deep oversold on the weekly, meaning selling pressure has been heavy enough that even the indicators are basically filing a complaint with HR. And the weekly 50 EMA is still right in play. In the sheet notes, we bounced off it. That gives the chart a line in the sand moment. The problem is, in a step-down trend, bounces can be real. Or they can be the chart handing out free samples of hope before slamming the door. So, weekly summary. Trend is still down-ish. Momentum is cooling. We're oversold. And price is flirting with that weekly 50 EMA zone, like it's deciding whether it wants to behave. Daily chart facts. On the daily, the sheet says we've broken just below the 200 EMA, but we might be retracing back to it. That's a classic moment. The 200 EMA is the market's emotional support line. And once you lose it, everyone suddenly becomes a philosopher about trend integrity. Momentum on the daily is weakening through the week, which fits the price action. The pre-market hype got sold into, and the chart spent the rest of the week looking like it wanted to crawl under a blanket. Daily oscillators are still oversold, which is the chart's way of saying, yes, this has moved a lot, but that does not mean you're entitled to a bounce. The market does not do refunds. Price around 2278 is sitting below the daily 200 EMA area, and still well below the shorter EMAs overhead. So if you want the bull case in one sentence, reclaim the 200 EMA area and stabilize. If you want the bear case in one sentence, fail the retrace and keep bleeding lower while everyone calls it healthy consolidation. Daily summary. Slipped under the 200 EMA. Momentum deteriorated into week's end. Oscillators are oversold. And now the chart is daring buyers to show up and do something other than tweet. 4-hour chart facts. On the 4-hour, the sheet says SOFI keeps bouncing around 2248. That's your near-term line. The chart's favorite rug. If price keeps tagging it, it becomes important. If it breaks cleanly, it becomes historically important, which is trader speak for, I will now stare at this level for the next 3 months. Momentum on the 4-hour is still negative overall, but the oscillator has started ticking back toward more neutral territory. AKA, the chart is trying to stop hyperventilating. That doesn't automatically mean reversal. It just means the selling may be losing some intensity. And the 4-hour EMA stack is overhead, meaning any bounce is immediately going to run into those prove-it zones, where sellers love to reappear like they set an alarm. So the 4-hour story is simple. We have a defined near-term level around 2248. Trend pressure has been down, and the tape is trying to decide whether it's done being dramatic or just taking a breath. Options, oddities. Now for the options, because this is where sentiment stops pretending to be subtle. We're looking at February 6th expiration, with an expected move of plus or minus 188. And current price 2278. That's the market implying a pretty live range into that expiry window. Not a guarantee, just what the chain is pricing. Open interest is loud, it strikes above current price. And the battlefield is basically 24 to 25. On the put side, The largest open interest is the 25 strike with 15,000 contracts, followed by the 24 strike with 12.6 thousand. On the call side, the largest open interest is the 25 strike with 16,000 contracts, followed by the 24 strike with 15.9 thousand. So in plain English, there's a huge crowd positioned around 24 to 25, and price is currently below it. If price starts drifting up, those strikes can behave like sticky magnets and speed bumps at the same time, because big positioning tends to attract chaos. If price stays under it, then that whole zone becomes the market's favorite. We used to live their story. Either way, the chain is not quiet. The chain is a group chat with 30 unread messages, and half of them are just question marks. All right, real talk. Do you think this move is macro-driven noise that fades? Or is SOFI entering a cool story, still stepping down phase where the chart needs time to heal? Drop your take below and include your favorite coping mechanism: doom scrolling, charting in dark mode, or telling yourself it's just liquidity. Like, that explains anything. If you enjoy overanalysis, chart therapy, and high-quality sarcasm, hit like, subscribe, and share this with a friend who thinks oversold is the same thing as guaranteed bounce. It's not. It's never that simple. Not financial advice. That's the SOFI read. Triple beat, raised guidance, record growth, and the chart still looks like it's walking through the rain without an umbrella. Remember, this is parody. This is entertainment. And the only thing we promise is that the market will remain confidently unpredictable. See you next episode, where we'll do this all again. Because apparently we've chosen stress as a hobby, not financial advice.